There are four main real estate investing strategies, but which one offers the highest returns for the lowest risk? In this video, I'm going to walk you through the four investing strategies and how they impact your portfolio. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about the four main real estate investing strategies and how they impact you. To start off, I'm going to define the four strategies and then we'll get into the risk and then the potential returns each strategy offers. So number one is the core strategy. Now, what the core strategy is centered around is it's all about buying a stabilized cash flow producing asset that needs almost no work at all. So basically you're buying a premium product. You don't have to do any work. You're just buying it. It's already producing cash flow. It's in a good location, premium asset, and you're just holding it for the long term because over the long term, we know the market goes up. And this is how you are making your money. Now, keep in mind, as I've discussed in past videos, we cannot control the market. We have no control whatsoever over the market. And as professional investors, we want to focus on things that we can control. But when it comes to the core strategy, you are buying the premium asset, you're not doing any work, you're just buying it and you're waiting it out for the long term. Number two is called Core Plus. Sometimes you'll see people put the plus sign like Core Plus. What this strategy is, it's the core. So you're buying that premium stabilized asset. You're going to get the best debt terms. You're going to get the best interest rates because you are buying that premium asset. But then you're going to do some light work to it. So maybe you're going to be replacing some flooring, changing out the facade to upgrade it. Again, this is very light lipstick types of work. You're not blowing up units and redoing it. You're not blowing up the exterior and adding things to the property. It's just very light, a light lipstick touch to it. So again, it's centered in the core strategy. So you're buying that premium product that's stabilized and you're just doing some light touch-ups. Number three is called value add. Value add can come in a light value add and a heavy lift, so a heavy value add. A light value add, you can acquire an asset, and there's really two components to value add. There's physical and there's operations or operational. With physical, you're doing renovation, so you're going in renovating the interiors of units, the exterior of the properties, parking lots, anything in between. On the operations side, you can put in new management, change the branding of the property. You can raise rents, do a RUBS program with utilities, add additional income streams. So those are the two components of the value add strategy. And I mentioned there's light and heavy. Light, you're doing more kitchens, bathrooms, flooring, paint, exterior work. And then there's heavy value add where you can get into a construction component where you're adding an additional floor even, where you have a two-story building and you could even add a third story on top. That would be a very heavy lift when it comes to value add. Or you could also buy an unstabilized asset and then bring it to stabilized status, and that's going to take a lot of work on the operations side and potentially on the physical side. So that's value add. So I'll draw a hammer right here for value add. And number four is opportunistic. Opportunistic is a catch-all term because it can encompass a number of things. Opportunistic, maybe you come across a distressed asset, you can actually move in and that would be considered an opportunistic play. It's not cash flowing, it's unstabilized, maybe it has huge vacancy issues and the owner's in trouble and you pick it up at a discount. That would be an opportunistic play. Another thing could be, so we'll say distressed. And then you could also do zoning changes. So maybe you acquire a property, go through the process of changing the usage, the zoning for that property, and then you knock down the existing building and build something new. That's the highest and best use for that property. And then you could just do new construction. So a new build. So you acquire a vacant piece of land, you build your 250 unit multifamily building on that. That would also be considered opportunistic. Now that we've defined the four strategies, we have core, core plus, value add, and opportunistic. How does risk come into play? Well, fortunately, I've ordered these in order. So basically, at the top here, we have the least risk or perceived risk, and then we have higher risk down here. And let me explain why. With the core strategy, we are buying a premium asset in a great location. It's already cash flowing. We're getting the best debt terms, interest rates. So basically, it's already making money. And we're not changing anything to the property. We're not injecting capital that we want to pull out later on. We're just acquiring the property and we're holding it for the long term. Because of this, it's considered the least risky strategy to do because there's really nothing. You're acquiring the property, it's already making money. And with a large-scale multifamily property, they are incredibly stable. So as long as you don't mess up the management and you don't mess anything up, if you're holding this for 10, 15, 20 years, you're good. As long as you don't have a significant rent decrease or something drastic happens. As long as you're buying that stabilized premium asset, you're getting great debt terms and you're just holding it. You're not doing anything. There's nothing really that you can screw up other than managing the day-to-day of the property. And then we have Core Plus. It's a little bit riskier because we are doing some renovations. And the more layers you add to a deal, the more things that can go wrong and the riskier it becomes. So you're doing some light renovations. Again, the asset is very stable. It's very stable. It's cash flow producing. So it's not very risky, but as you add more complexity, the risk factor does go up. Then you have value add. Obviously, a lighter value add versus a heavy value add, the risk does change there. If you're doing a huge heavy lift with the property, obviously it's riskier because you're injecting more capital into it. Chances are the property is not going to be stabilized if you're doing a heavy lift, and that sort of thing comes into play. You're going to be working with bridge debt potentially, and again, it's adding more complexity to the deal, so then the risk factor does go up. And then with opportunistic plays, if you're picking up distressed properties, obviously, you have to do the work to turn those properties around, and there's a lot of factors that can come up that can make that difficult. Zoning plays, what happens if you acquire the property, you go through the entire process and then it gets denied, you appeal and then it gets denied again. That could be an issue. And then with new construction, your timeline is so far extended, markets can shift, all these things have to line up for the project to be completed on time. This is why opportunistic is considered the highest risk. So the question is, how are investors compensated for the level of risk they are incurring by investing in these real estate investing strategies? Well, the lower the risk, so with the core plus type of strategy, you're going to have lower returns. The reason is you are investing your capital, placing your capital in a less risky investment or a perceived less risky investment, and therefore investors are willing to take a lesser return, a lower return in exchange for that security or perceived security. Now, as we go down the stack here and we get into value add and opportunistic, obviously the returns go up. And the most risky, which is opportunistic plays, if you're acquiring a distressed property and you're doing a whole lot of legwork and turning it around, or rezoning or building new construction, you're going to be compensated as an investor with the highest potential returns because you are placing your capital at the greatest risk because more things can go wrong. There are more layers of complexity. So which one is best? Well, that's for you as the investor to decide. Are you willing to take a higher risk and have a higher chance of potentially losing your capital in exchange for that higher return? Or are you willing to take a lower return, but then place your capital in a perceived less risky investment? Where's the happy median here, or a happy medium? Well, in my opinion, and this is what I think, is value add. This is the winner for me. The reason is, typically with value add properties, we are acquiring a cash flow producing asset. So it's already making money, similar to the core and core plus strategy. But then we also couple with it improvements. So either through physical renovations or operational improvements, management, raising rents, that sort of thing. So it almost marries the opportunistic play where we're doing renovations and heavier lifts and the core strategy of acquiring cash flow producing assets. And this is why value add, I think, is a great balance between the risk involved in the deal and the returns you are receiving, because you're buying that cash flow producing asset most of the time, and then you're doing work to it to improve and force the appreciation of the asset. And I've done videos in the past, and I'll put a link right up here to a video I did explaining all about the value add strategy. So check that out if you are interested. So this is my opinion. Now, obviously, other investors may feel differently. Somebody may choose to take a core strategy, invest in a deal that's going to be held for 15 years and just ride it out. That's totally fine. Everybody has different risk profiles. But for me, I want to make sure my money is working as hard as it can be. So I want to get the cash flow produced by cash flow producing assets, but I also want to put it to work and really have my money working hard, and that's through doing the value add strategy with physical and operational improvements. So those are the 4 main real estate investing strategies, and if you're interested in learning more about multifamily real estate investing, join my free Facebook group. It's a great bunch of people. The link is right down below this video. And if you are an accredited investor and you want to learn more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel. And until next time, happy investing.